Right when headlines started screaming that gold had finally broken the unthinkable $5,000 level, something strange happened. Almost instantly, the celebration turned into confusion. Prices slipped back toward $49.50. Silver flirted with $95, and people were left asking the same question at the same time. How does an asset smash a historic level and then fall so fast? Because this didn't feel like a normal pullback. It felt sudden, sharp, and emotionally jarring. And if that caught you off guard, you're not alone, because what just happened wasn't about weak fundamentals or a sudden return to economic safety. It was about timing, psychology, and how markets react when a symbol becomes too loud. In the next few minutes, I want to walk you through the real story behind this move, why breaking 5,000 was actually the trigger, not the victory, and why what looks like a crash may be something far more deliberate. So stay with me. And before we go any further, if you value clear thinking over panic headlines, take a second to like this video and subscribe to Elite Capital Decoded, because understanding why markets move matters a lot more than reacting after the damage is already done. What shocked investors wasn't that gold pulled back from a big number. That part is normal. What shocked them was the speed and aggression of the move. One moment gold was being talked about as unstoppable, a hedge against everything, the ultimate safe haven, and the next moment it felt like confidence vanished overnight. Silver moved even harder, swinging fast, shaking out anyone who was late or leveraged. And that emotional whiplash is the first clue that this wasn't random, because markets don't usually turn on a dime unless something breaks psychologically. The $5,000 level wasn't just another price, it was a symbol. It was a headline number, the kind that changes conversations at dinner tables, on TV panels, and inside political offices. And when gold crosses a number like that, it stops being just a trade and starts being a message. A message that says currencies are losing trust. Debt is out of control and people are looking for protection outside the system. And history shows us that when gold sends that message too clearly, the response is rarely calm. We've seen this before. When an asset becomes the focus of fear and attention, volatility follows. Not because the story ended, but because too many people rushed in at once, chasing confirmation instead of understanding risk. And when that happens, even strong markets can snap. Silver's move to the mid-90s made this even more intense because silver is thinner, more emotional, and far more sensitive to leverage. It attracts fast money, and fast money leaves just as quickly. So when gold hesitated after 5,000, silver felt the pressure first. Stops were hit, margin calls followed, and suddenly what looked like strength turned into forced selling. This is where most people get it wrong. They assume a sharp drop means the story is over. But sharp drops often mean the opposite. They mean positioning got too crowded, expectations got too loud, and the market needed to reset who actually gets to stay in the trade. Breaking 5,000 invited everyone in. The pullback was the market's way of asking who really understands why gold is there in the first place. If inflation were magically gone, if debt no longer mattered, if confidence in paper money was fully restored, this move would have come with strength everywhere else. But that's not what we saw. We saw hesitation, defensive behavior, and nervous positioning across assets, which tells you the fear didn't disappear, it just shifted form. What happened here was a classic reaction to a psychological milestone. Once gold crossed it, expectations jumped too far ahead of reality, and markets hate one-sided emotion. They'd punish certainty, especially when it's loud and crowded. This is why calling this a crash misses the point. Crashes usually come from surprise weakness. This move came from excessive confidence, and there's a big difference. The truth is, gold at 5,000 forced a conversation the system wasn't ready to have yet. And when that happens, pressure builds, volatility rises. And price moves fast in both directions, not to destroy the asset, but to cool the narrative. Silver's dip toward 95 felt dramatic, but silver has always exaggerated emotion, on the way up and on the way down. And that is exactly why it is often used as the pressure release when markets need to flush leverage quickly. None of this changes the deeper reasons gold ran in the first place. Debt levels are still massive, inflation pressures haven't vanished, and trust hasn't been fully restored. What changed was the pace and the psychology. Markets don't move in straight lines, especially when history-making levels are involved. They test conviction, they punish late entries, and they reward patience. This is also where many investors make their biggest mistake. They confuse volatility with failure, and they let a fast pullback convince. Them that everything they believed 5 days ago is suddenly wrong when in reality nothing structural has changed, only the emotion has. The most dangerous phase for any market isn't the top or the bottom. It's the moment when people feel embarrassed for believing in the story at all. When confidence turns into doubt and silence, because that's usually when positioning quietly rebuilds. Elite Capital Decoded exists for moments exactly like this. Not to hype numbers or promise straight-line moves, but to explain why markets behave the way they do when psychology takes over. Because once you understand that, these moves stop feeling chaotic. The real question now isn't whether gold bounces tomorrow or silver retests a level next week. The real question is whether the reasons that pushed gold toward 5,000 have actually been resolved. And so far the answer looks a lot like no. As things calm down and headlines move on, that's when clarity starts to return, and clarity is always quieter than panic. Before we wrap up, I want to hear what you think. Do you believe this pullback was a healthy reset after a historic breakout? Or do you see it as a warning sign that something bigger is coming? Drop your thoughts in the comments, because different perspectives matter right now. And if this video helped you understand the move instead of reacting emotionally, share it with someone who's still confused. Stay subscribed to Elite Capital Decoded. Stay calm, stay curious, and remember, markets don't reward excitement, they reward understanding.